Hi there folks, it's James Marley here, co-founder at Livewire Markets, and welcome to this update on my SMSF portfolio. But more importantly, we're going to get some expert tips from Ben Clark, who is from TMS Private Wealth. Now you may remember at the start of the year, I sat down with Ben and Charlie, who unfortunately couldn't make it along today, to get their views on putting together a portfolio for 2025 and beyond. We got some pro asset allocation tips. They ran the ruler over my SMSF. And it was a great session. Really appreciated your time in that one, Benny. It also sparked a lot of comments from our readers around how to access private markets. So for today's session, we're going to get a bit of an update on markets from Ben. We're going to get an update on my SMSF, no major changes. And then we're going to dive into that private markets, private equity piece, and try and address a bunch of the questions about how you might access that part of the market, how you go about selecting investments. And then I've rattled off a bunch of the questions that came through from our readers, and Ben very kindly has offered to take them on the chin. So Benny, with that, welcome to the show. Great to have you in.
Thank you. Sight unseen, those questions, so let's hope I can answer them. But I'm looking forward to the conversation. It was a good one last time. It's a shame Charlie couldn't make it.
Yeah, it is a shame. I think he was feeling a bit nervous about the bonds bet that you guys had going on. He might be ducking for cover.
I was going to bring it up. He's hoping for a second half sell-off.
So let's do the little mid-year update. At the start of the year, you guys were kind of, I wouldn't say cautious, but just judiciously willing to put additional capital into the markets. Yeah. Have you dramatically changed your views since where you sat at the start of the year? Because we did have that rocky April, but things have steadied pretty well.
Yeah, they have. So, leading into Christmas, we were trimming our Australian share exposure and we were starting to invest in some of these private asset names, which we felt had significantly underperformed public equities, and there'd been this big valuation gap that had opened up. We're sort of feeling like there was a bit of depression in that area and there was a bit of euphoria in this area. And of course, since then, what I'd say, Jimmy, is that what we've seen is it's almost uncannily similar where we are at today versus December, but so much has happened in the period in between.
Yeah, it's crazy.
And, we effectively had technically a bear market in America. Their market fell 20.5% or something like that. Our market wasn't far behind that. And then we've seen a V-shaped recovery, which is very rare. You normally see a market grind its way higher and fall lower. So it doesn't always work out like this, but we did have some cash because we were a bit more cautious in December to put to work in April, which we picked up a couple of new names, which we've had our eye on for a while now. But we're back to where we started. So I thought back then I brought the earnings yield of the ASX.
We'll bring this chart up there for
from Market Index. And I just thought I'd talk to it again because it's a good point of reference. And what that shows us is that the market has again got pretty expensive, but not as expensive as it was at the end of last year. Yeah. And there's two reasons for that. The first is that we're now rolling onto FY26 earnings forecast, whereas we're using FY25 back in December. So the market's expecting a bit of earnings growth this financial year. Yeah. And secondly, we're seeing earnings upgrades in the resource space, which we haven't seen for a while, and it's a big part of our index. Yep. But despite that, our market's about 2 or 3% above where it was when we last spoke. So I'd say from an index point of view, getting cautious again, still seeing little pockets of value in individual stocks and some of the sectors in the market. But overall, I think coming into reporting season, it's going to be volatile. Everyone's saying that, they're right. And it's going to be a little bit underwhelming, I think. But attention's going to turn to FY26, where we might finally be starting to see some profit growth on the ASX 200.
It was present when we spoke in January or December last year. Seems to have picked up, as you said, which is this theme of concentration and momentum. Yeah. AI stocks running, CBA getting bigger. Is this just now a feature of markets that we need to kind of be mindful of and embrace because it's dominated the pages of our website and lots of other news websites?
Yeah, completely. I mean, it's been such a talking point, and the thing I'd say is, like, for 10 years now, commentators have been saying the US market is so concentrated, but if you haven't embraced that, you've left some big returns on the table. So I would say, don't be overly concerned about that in America, and I'd say don't be concerned about in Australia if you're self-investing, because you don't have to invest in the more concentrated parts where you can pick away at some of the things. I do think it's something to be aware of if you've got more of a index focus, ETF focus in Australia, because I can see some pretty big parts of our market not doing a lot share price wise for the next 3 to 5 years, and I'll be calling out the banks specifically in that. And even the resources, yes, they've had a good bounce. China's looking hopefully a bit more optimistic, but we've seen it's a real roller coaster ride, and that's kind of 60% of our market is those two areas, banks and resources. So to us, as it's always been the case where we've been able to find better opportunities outside of those areas, and I think that's the approach we'll keep taking.
So for those maybe investing in the stock market using a broad index ETF, you're saying, maybe need to think a little bit laterally around some other parts of the market. Do you do that? Fund managers, direct equities, what's your approach?
I think it'll be different for different people. So there'll be people who are comfortable with individual risk of stocks, and there'll be people who should probably leave that to fund managers.
Yep.
And that might be a conversation to have an advisor or talk to your partner or whatever about. But I do think you need to be aware that the concentration of the Aussie market and the strength in those two parts of our market has been profound, and valuations look very full. So thinking about how you can get diversification, maybe it's into smaller mid caps, and maybe it's into more industrial funds that are outside of banks.
Yep. A quick one just on frothiness in the market. We had that Liberation Day correction, which knocked all the froth off the cappuccino.
Very quickly.
Now we're back at the pub and things are bubbling over again. We've had a big IPO in the US with Figma that went absolutely gangbusters. Yep. Bitcoin, great risk proxy, is going through the roof again. Too frothy, just natural part of markets. What's your take?
Great signs that the IPO market's opening up, and that kind of will feed into the private asset part of the talk that we're having. We've had 3 floats in Australia, which are pretty decent size. They're all still trading above their IPO price. So it feels like the floodgates are very slowly opening, and they're shutting and then they're reopening. And so it's in fits and spurts. But I would say the outlook for the IPO is good. And look, I think there's expensive valuations without froth. I mean, we're going through the quarterly earnings season in America at the moment, and yes, a lot of these stocks are, the names we all know are trading at all-time highs, but the results have been very strong, and that's despite a lot of these businesses reinvesting significant amounts of money into building out this AI infrastructure, which is coming off their bottom line. So if your time frame is short term, I'd be pretty wary right now. But if you're still thinking 5 to 7 years ahead, it's maybe skimming a bit of money is not a bad idea, but you still want to stay invested.
Of course. Alrighty, folks. I'm going to put up on the screen my current SMSF holdings. Just a word of warning, I'm not a financial advisor. This is definitely not a recommendation for you to follow my strategy. Everyone's got their own approach. And in fact, in the last session, both you and Charlie said you wouldn't recommend holding my portfolio. I did try and implement a few changes.
I reckon it's done pretty well.
Yeah, it has. Did 21% for the last year, so
okay.
not a
That's
bad
a great
year.
Return.
But no major changes. I did trim some of my small cap exposure and the 2 global growth exposures. I took about 15% of the portfolio out in late December, early January. I also sold some gold in April and used it to buy some ResMed. But the big issue I had was, what do I do with the funds that I'd raised? And rookie error, I didn't have a bench of ideas ready to go. My intention was to go and do some work on private markets and think about getting some diversification, which is one of the recommendations or the suggestions that you guys made. And what dawned on me was that it was actually a really difficult process, and a lot of readers commented on a similar theme. We use a data provider at Livewire. I requested a list of private equity funds from them. We pay 5 figures a year, good chunk of money, and I wasn't able to get hold of the list. So I'm not sure how the average investor would do it. So Ben, this session here, we're going to try and do a bit of education around investing in private equity and that private market space, which I know you've done a lot of work on. So why don't we kick off? How do you break down the universe of private equity investments? Like, do we think about it like value, growth, small cap, mega cap? How do you do it?
Different groups will have different ways, but the 2 most common ways, the first way is pretty simplistic, it's liquidity. So a lot of advisory groups in America, and we've been looking toward America because we think they're about 3 or 4 years ahead of where Australia is, in terms of structures, etc. We'll look at liquid vehicles, semi-liquid, some liquidity but not a lot, and illiquid, so closed-end funds. And they will look at blending managers across those based on a client's expected cash flows, time of investment, time that they need to reap money out of that portfolio, etc. And they'll try and align that with against a client. Probably, I think for me, the best way of doing it is actually to break it down into like private markets. You say private markets, it's such a broad scope of different areas and managers, and it's the subcategories I look at. So you've got venture capital, which is probably the most
early stage,
but the riskiest, highest potential payoffs, but also a lot of risk of capital loss. If you're going in the wrong year, 2022 was a disaster for VC. Then you've got growth equity. So that's managers that buying a chunk of a company, that money is used to try and propel the growth of that business. They're investing alongside the founders, and they will bring in some intel to the business to try and help speed up the growth of that company. And it's more of a partnership approach in terms of how they take it.
Yep.
Then you've got the buyout funds. So that's a business. We would typically think in our heads about a company coming, raiding a Virgin or a poor performing ASX business and taking it off the market. But in actual fact, it's more common that they will buy a private business and they will own 100% of that business, so that the owners are tapping out.
Yep.
And they've got a view that we'll bring in, I've got this guy who ran a very similar business very successfully. I'm going to bring him in to run it. I'm going to put these people on the board. I'm going to put in this person in marketing and HR. We think we can completely restructure, change the strategy, get the balance sheet back under control, and re-engineer growth. And then with a view to selling that business either to a share market, a trade buyer, or another private equity firm at some point down the track. And in between that, they'll have an independent valuation consultant who's modelling the cash flows of that business, applying an appropriate multiple, and that's how the unit price will change to reflect all those businesses.
Yep.
Then you've got secondaries, which is huge in America, and it's quite small here, but it will become bigger. So a secondary manager, so say you got the Future Fund, is invested 8% of the portfolio in venture capital, closed-end funds, no liquidity. They have a change of CIO, or they have a change of view on their investment committee. They think we've got too much, we want to get that down to 5. What will happen is one of these big secondary funds, there's a market at which they will buy that in all of those investments from the Future Fund at a discount to what the asset value is.
They're like liquidity providers.
Exactly. And their view will be, it's a 10-year fund, we're buying this in year 7 at a 20% discount. And whatever, the returns, it'll start paying out capital over years 7 to 10, and we'll get that plus 20%.
Yep.
And it's actually a good sign of the state of the market is the gap that these guys are buying at. So at one point, venture capital was being bought at 40, 50% discounts. At one point, secondary funds were paying premiums because they thought the asset prices were just going to keep going up. So that's a big part of the American market. Then we've got fund of funds. So we've got funds that invest in all of these sort of funds and try and give you a diversified exposure across a lot of different ways of managing private asset money. You've got infrastructure funds. You've got private credit, which is enormous, and will continue to grow significantly despite some of the articles that you might read. So that's funds lending money to companies. It's funds lending money to property players. It's funds lending money against property. It's funds lending money to other private equity funds. It's a huge business because they're typically geared up.
Yep.
And then you've got real estate funds. So that's kind of how I break it down into those different categories. We've invested in 4 of those categories over the last 3 years.
Yep.
There'll be some that will appeal to some clients, and there'll be some that aren't the right thing for others.
How do you get a starting point for a list of managers to evaluate? Because that was one of the big hurdles that I faced.
Yeah, and look at, we properly got into this about 3 years ago, and it's probably one of the biggest hurdles we faced. And I can only speak about how we went about it, and I understand that not everyone is an advisor and has these connections, but this is how we did it. I mean, so we found 3 or 4 really good distributors of private asset offerings that were coming into the Australian market or are in Australia. These are businesses that run due diligence on some funds. They can see quality. You've got to do your own due diligence on the provider and be comfortable that they're looking after your best interests and your clients. So there's one, Apex, AIPX, who have really been instrumental in getting us in front of a whole lot of different managers, and that's helped massively speed up our education of the whole space. Yep. Pinnacle, I think, have been excellent. Emily Pearson here in the Australian market has been really good at us telling her what we're after, and she'll say, go and see this guy, go and listen to this, I'll get you into this lunch. And that's probably been the fastest way. Industry contacts have been big for us. So like the advisor network in Australia, I think is as high quality as I can remember it, and it's flourishing. And, I'd often go and take someone out to lunch in the industry and say, give me a name of a manager that I should go and meet or listen to, and they'll connect us together, go along to that. Some of our clients have actually been great because
lead generated.
Yeah, they have. I mean, one we're going to talk about a bit later, but we've got some clients who run family offices that have got investments in areas, and they've said, go along and have a listen to this guy. So, and then there's sales managers of the individual funds. Livewise, a great point of reference. I think you can learn a lot, and it's just. But I think the main thing for us has been getting in front of the people and asking them a whole lot of dumb questions and just learning
as you go.
Yeah.
So for our readers, a lot of them quite curious about this segment. I need to ask, how realistic is this segment for investors? We have people that would be high net worth, we've got advisors, but there's also self-managed super funds like myself, and there's also what I would call confident and informed retail investors that don't qualify for that sophisticated investor. Like, how realistic is it for these people?
To be honest, I say it's unrealistic because, and I don't want to, I'm not saying this to try and say go and use an advisor. It's not why I'm saying this. It's because from what we have seen is that the high quality managers want an intermediary between the client and themselves. So they want an advisor who's educating the investor into their fund about what the liquidity looks like, what the risks are, all of those sort of things. They're not going to deal with clients on the street directly. And I'd say if there's one point of caution I'd have is that the fund managers that are willing to do that, I would say are typically in the lower quality area, and I'd be a bit careful. Not everyone, but a lot. The other thing is you've got to be on a platform, which is so NetWealth or Hub24. If you're applying to go into a fund, these are done on platform. If you want to redeem, it's done on platform. The reporting over distributions, etc., is done on platform. So if you saw one of the application forms to invest into a feeder fund that's going into a fund in the United States, they don't want to worry about anti-money laundering, know your client, all these sort of things. The platforms handle this electronically, instantaneously. So, and then the third thing I'd say is what we have actually found is that the managers that we've really been, look, we want to get into this fund, it's actually been quite difficult. You've got to spend time with them, and in some cases they're almost doing due diligence on us because they don't want a whole lot of TMS clients coming in and then 2 years later 20 of them are leaving to go somewhere else. They don't want to have to worry about that. So it's challenging if you don't have that sort of distribution.
Okay. What about things like ETFs, LICs, active ETFs, which are more readily available to most investors?
Yeah, I'd be wary again. I just think a lot of these funds, so that the big new trend globally and led by the United States is this evergreen structure. So that's semi-liquidity, where you can typically get sort of 5% of your capital paid back out to you every quarter if you want to redeem. So there is some liquidity there, but you can't just ask for your money back. Yeah. And typically at the start, there'll be a closed-end style to it. It's very hard to match up a ETF, etc., with daily liquidity against these sort of structures that don't have daily liquidity, because the risk is that too many investors ask for their money back at the same time. And if it's an ETF, it's got to trade at something. If it's a a fund of funds, it can freeze,
Yeah.
which can be a real challenge. So I haven't seen anyone that's managed to find a listed structure that does this well. You're also paying fees on layers of fees, which can make it expensive. I would say in private credit, there's definitely been an improvement in the vehicles. So, a big criticism of them was, you had an NTA getting published every day, but the share price could wildly differentiate from it. They're now putting in mechanisms where to make sure that the prices trade very close always to NTA, which means you can sell and get your money back at the right price. So that's probably been the area that I would say has handled it best.
Yeah, well, we've just had a recent article written by Darryl Wilson looking at the listed investment trusts. A lot of them are private credit on the ASX and doing a deep dive. I'll put a link to that one in the article below. Ben, I did ask you to bring along an example of a manager that you use and why you selected them.
Yep.
You happy to talk us through it?
Yeah, I can. So there's a couple I wanted to talk about, and it's the US ones in particular are really worried about SEC rules, so they've asked us not to bring it up. But I'll bring up one that we've just actually put money into, because I think it kind of tells the story of how these structures and stuff can work and how different it is to investing in listed. So the manager is called Straightbat, which is a Melbourne-based manager in Australia. Invests in mid-market businesses, typically $20 to $15 million of EBITDA, highly cash generative, robust, typically do well through economic cycles. And it has a real focus on income, which is a big priority for our clients, and has a mandate of hoping to pay out double-digit income plus capital growth that keeps pace with inflation or better. So how do we come across them? So actually a client of ours introduced us to them 2 years ago. Yep. He's been a very early investor in them. So Straightbat's come out of Jeff Harris's family office, who was the co-founder of Flight Centre with Screw Turner. Yep. And has got a really good selection committee, they call it. There's a lot of cricket analogies.
I was about to say, it's the selection.
Well, the term Straightbat is, we're trying to hit singles and just build up innings.
He's probably an opener.
We play with Straightbat, yeah. We were introduced, went down to Melbourne, met them, super impressed. Now, the interesting part of the structure is that they will typically buy one business a year. And one day of the year, they will take on new applications to be an investor. Existing investors get first rights to take up those applications, and potential new investors second in the queue. And I think at the moment, there's nearly a 2-year waiting list to be an investor. So
sounds like the MCG.
It does. Their office actually looks over the MCG. So when they did their last process in June 2024, we sort of said to them, we'd really like to come on board. They did quite a reasonably small acquisition, and the existing investors, I think, took the lot. This year, they've done the biggest acquisition in their history. And we got a call in March saying we think we will have some room for your clients. So, and we were able to come in the June raising. So this has been like a nearly 2-year process to get the clients access to it. And it kind of speaks to the fact when we went down, really wanted to know about our clients and how we invest, and they want to know who they are, et cetera, et cetera. So there's a bit of that goes on. Look, this will be a multi-year investment for us. We'll now be able to top up that investment on first rounds going forward. So they actually they settled on this acquisition last Thursday, so I can talk about it. They bought a business called 1300 Fencing, which is the largest temporary fencing provider in the country. Mm-hmm. If you do a renovation on your house, first thing that goes in, fencing. Yep. Last thing that comes out, the fencing, because of the OH&S rules. If you go to a sporting event, a concert, the Olympics in Brisbane, if you drive past a road and it's being built on, there will be temporary fencing everywhere. And these guys are the number one player. It's a founder-led business. Straightbat will now own 50% of this business. They already own a rental equipment business and have guys on the board of that business. So they've got experience. And they will come in saying to that business, we don't just want to be a passive investor, we want to help you grow this business faster. And we can bring people in who are existing investors in the building industry, and they've made a lot of money. and give you some advice. We can help put people on the board. If you're looking for a person because your marketing lady's left, or we've got a candidate we know who will fit perfectly for this, and it becomes a partnership.
Yeah. So that's super interesting.
Yeah.
And sounds very appealing. But as we've kind of identified through our chat, it's probably not achievable for a lot of investors and potentially for a lot of people watching this this video, probably myself included. And so the question becomes, is private equity, private assets, is it worth it for someone like us? And what's the alternative? Should we just be, playing a straight bat in the public markets?
No, look, I think it is still worth it. Straight bat is a bit of an extreme example in terms of getting in, but it's interesting to get your head around how these structures do work. If you're on platform, there are some great managers out there, and if I was calling out a few, if you want me to.
Yep. I think our readers would love you to.
Yeah, so that where you can put money into an existing fund, and it's a fairly easy situation to do. It's quarterly money in, money out. There are rules around liquidity and all these sort of things that you need an advisor to make sure that you understand before you go in. But we've put money into 5V, which is a
Pinnacle fund?
Yeah, a Pinnacle fund, and we were super impressed with the people that we met there. And the people, Jimmy, I think are the most important thing you're backing, and their track record. Hamilton Lane, which is based in Philadelphia. They are the largest player in secondaries globally. I think they manage about $700 billion US. Yep. And size matters in these markets. So there's two things I've learned: track record and size matters. In shares, there's mean reversion amongst fund managers. You might have a Hyperion, does really well for a couple of years, and then it has a bad year, and then it does well. But they do tend to, over shorter term periods, they can come back to the pack. That doesn't happen in private equity. Top quintile performers tend to be top quintile performers continuously. And that's because they can pay the best people in the market to come on board.
They get the best deal access.
Exactly, all those things. And so bigger is better. And status matters, like the name of the brand matters. So Hamilton Lane and Partners Group, which is based out of Zug in Switzerland, they have a global value fund, so that's in the buyout area. Yeah. If I was giving you a quick example of a business in there, they bought the Breitling watches business off the family, which had owned it for hundreds of years. And I don't quote me on this, but they, in terms of where Breitling was versus where it is now in market share, significantly improved it, and it's looking like it's going to be a great investment for them. So they're the sort of businesses they'll look at and think, this has turned into a lazy business, it's lost its luster, there's still a great business there. We think we can change your shop formats, the way that you sell your product, the way you release your product, where it's manufactured, put more money into marketing associated with these sort of things, and we can bring in all these people that we know can do this, and they can start to accelerate that business. So there's some names for you.
Yeah, awesome. And a couple there in the Australian market.
All three of those, you can become an investor in through an advisor if you're on a platform, and they're three funds that we've backed.
Alrighty, we're going to quickly rattle through a couple of reader questions. We've already done the deep dive on private markets, which was a common request. We've also touched on the fact, that question around, is this achievable for the average investor? One question that came up was one thing missing in the portfolio is diversification call, to hedge against beta risk. Now, this is a comment on my SMSF, which you guys rightly called out. And our reader says there seems to be a lack of really good hedge funds in the Australian market, like the ones in the US market that can provide that protection in a down market.
Yep.
Do you agree?
I've always been wary of hedge funds. I think they can, particularly the ones we've seen locally, get paid a lot, and they've got benchmarks which are the RBA cash rate that you could almost jump over and outperform, and they charge heroically, and they tend to come and go. But I would say in the United States, it has changed my view. So Apex, they put us in front of a group as an example called Schoenfield, which the Future Fund is one of the major investors in, and they have a very strong track record in all market environments, and it's one we have been looking at. So the issue is getting access, because I think there are actually some good hedge funds. They've just for many years been out of the reach of ordinary Australians, and suddenly what the technology which allows these guys to talk to Australian investors through feeder funds, and these guys also saying we need to embrace the high net worth channel and not rely on institutional investors who are trying to cut our fees, and they can suddenly pick up the phone and say we're pulling our mandate tomorrow and we've got to fire a whole lot of people. They are 100% embracing this channel. They want to work with the channel because they see it as something that's going to continue to grow.
A question was raised around the allocations we discussed in our first video.
Yeah.
Scared to mention, the reader wrote, no mention of crypto. My comment was you would probably deal with that on a case-by-case basis if clients really request it, but perhaps a comment on crypto from you?
Yeah, look, crypto's been something I've got completely, I wouldn't say I've got it wrong because I kept an open mind to it, but certainly haven't gone into it. And it is quite hard for advisors to manage that for clients. And the biggest problem for me is a crypto worth $1 million, $100,000 or $10,000? I don't think I can add any value to that question. And to be honest, I've been wrong on the answer to that question for some time now. I sort of feel like the moment I touch it will be the moment it goes to dust. So that's been my reply to clients, and I've said, look, these are the places probably to go if you want to go for it, but it's probably best just to do it yourself.
Final question, and I know we kind of touched on it before, but just some readers asking us to talk about alternatives in the LIT and ETF space. It's not how you choose to play alternatives, is that right? That's
right. So I would rather go, our view is we'll hopefully end up with 6 to 8 managers who are diversified. We've got 2 venture capital managers, we've got an equity growth manager, we've got buyout, we've got secondaries, we've got Australia, we've got global, and we'll keep, I think we've got a couple more that are on our radar. And what we would hope to be able to give is through getting direct access to these channels rather than going through a structure which I still don't think anyone has been able to nail, and I don't quite know how you do nail it, but someone very smart will probably think of a way. Maybe it'll involve crypto, who knows? There'll be a private equity stable coin or something, so I'm not sure. But I haven't seen anything as yet that would make me want to go for that versus what we're doing at the moment.
Okay, we're going to wrap things up there, but Benny, just going back to your asset allocation, what we've talked about there, at the start of the year you sort of said 10% to alternatives, and that contains those investments that you've alluded to through our discussion?
That's right, and again I'd sort of say we would hope that's going to settle at I reckon about 15. And that money has been coming out of, we've been skimming some of our Australian shareholdings, we've been holding our global share exposure, we've skimmed a bit of property stuff that we've got there, fixed income unchanged, cash unchanged. So that we're using listed to fund unlisted, and we're using what we think is expensive low growth Australian liquid to fund hopefully high growth with less volatility. Which is, we haven't spoken about, but one of, I think, would be the big benefits is in blending private asset markets with public, is it will smooth out the ups and the downs. And if you looked at some of those funds that I rattled off, there was 0 volatility in March, April, May. The businesses are being valued on what they're worth, not what someone is willing to sell or buy them for in the short term. And that was probably a good testing time, and I know that clients kind of through that period, I've got a number of comments saying it doesn't feel like we've come down as much as we would have in these markets, and it's hopefully doing its job.
Alrighty. Well, Ben, I said it last time and I'll say it again, I really appreciate you coming in and sharing this advice. It's great learning for me, hopefully some great learning for you. Remember, Ben is a professional financial advisor. We'll put a link to the TMS Private Wealth website at the bottom of the wire, and I hope you learned a bit about that deep dive into the private markets investment options. And thank you very much for watching. We'll catch you next time. Thanks, Benny.
Thank you.